if you focus strictly on the best of the best, right? You want, when I say story, what company is changing the way we work, live, communicate, what's making the most money of the big funds who are buying these companies? Are they continuing to accumulate shares? And what kind of long-term track records do they have, right? And top relative strength, right? We're looking for the strongest names. So that is, that's the key focus of any model book I'm working on. First, you want to define what is the objective of your model book? What are you trying to do, right? And then understand, what are the best situations for that particular study, right? So for me, I'm looking for the highest performing stocks, let's say with the fastest growing earnings. You might be looking for the stocks of a particular liquidity in a certain group. Let's assume the stock was a blank chart. The first thing I will do is launchpads, and I don't have them circled here, but we've got a very loose launchpad situations going on here where you've got moving averages crossing, but it's not anywhere close to the launchpad, the nice tight launchpad setup we've got going on here. So that's what's pointing me to this area near the bottom. We're starting there, well aware that Nvidia is the biggest winner in the strongest semiconductor group here. And again, so this is great because now we can see all the way to the left side where I started a lot of these lines and have dragged them across. Right, look how tight that is. Volume disappears to nothing. Big blue, small red. This is exactly what you want to see, right? Big on the way up, small red on the way down. I can't say enough how important it is to build the model book. So do yourself a favor, when you're doing your post analysis, figure out what are the 5 stocks you wish you traded or the setups that you wish you had that you missed it. So yeah, just that process has done so much for my thought process, my entries and exits, developing my rules. It aids the post analysis incredibly. They go hand in hand. Anytime I build a model book, these are the things that never change, that top-notch story, right? And that's why it's like one of the first things I put in the model book. I want to know, it should be clear what the company's doing, why are they there, how are they changing the way we work, live, or communicate.
All right, welcome back everybody to the next presentation of the 2024 TraderLion conference. We have our next speaker, our very own Ross Haber, co-founder of TraderLion. Previously, as many of you know, back in the 90s, he first worked at William O'Neill & Company in institutional sales. Then he was handpicked by Bill to become a portfolio manager. And while there, worked on many special projects, including the 1998 to 2000 model book, along with Mike Webster and Charles Harris, where they studied the greatest winners right there and then, and developed a lot of tweaks to their system, early entries, key price and volume characteristics that they would then incorporate into their own processes and kind of adapt CanSlim to then. So today Ross and I will be discussing the importance of model book studies. Many of the previous speakers over the past weekend have discussed, how important it is to go back, study a setup, do a deep dive, go back and study the greatest winners and look for the characteristics that they shared. And this is basically a step-by-step walkthrough of how Ross does just that every single year, looking at the greatest performing stocks. So Ross, thank you so much for being here. Please welcome him in the chat, and we'll go ahead and dive right in. Ross, great to have you here.
Thank you so much, Richard, and thanks everyone so much for being here. So we're going to go ahead and dive right into what is a model book, right? So we're going to be talking about model books with regard to how I've made mine, my methodology, like Richard said, finding the greatest stocks over a specific period in the stock market, and then trying to see what's going on during this period relative to others, tweaking some rules, largely entry and exit, right? It's always about refining and having that optimal spot to buy a stock and set your sell stop with as little thinking as possible, right? That's the idea behind it. It really helps you hone your rules. It helps you get a feel for the art of the market, right? The more you do this, the more you realize what stocks are doing during what periods, okay? So for those reasons, it is winds up being an incredible reference tool, not to mention the process itself. The more you do it, the better you're gonna get. It winds up being a very personal thing. So you'll see as you define your study, and you do your first one, you'll have some aha moments, you do it again. And that in addition to having just a phenomenal reference that builds up over time historically that you can go back and compare to, it's a must do if you're a trader. I don't care if you're a day swing or a position trader. I would say that. And as you can see, so for my process, like Richard said, I'm looking for the best stocks and the best groups with the best fundamentals that went up the most for the year. I want to see how these stocks are acting, how many bases did they build, all of these things that are important to me with my entry and exit process. And it may be you can notice breadth over that period, confirmation, one group to the next. It's all of these things, all the way down to the nitty-gritty of entry and exit. So how do you do it? That's what we're going to get into, from starting with our large lists to our first blank chart. How do we draw the lines, why we draw them, and give you an idea of how and why at least a model book from my perspective, from my methodology, works. And then hopefully you would be able to then draw from that and apply it to whichever way you do yours. So that's the idea.
And jumping in just a second, just because I think this is especially useful if you feel like you're kind of stuck, and you can go to the next slide. But if you feel like you're stuck or you're missing a lot of the best opportunities at the moment, maybe you didn't catch Nvidia this year, SMCI, you saw other traders on Twitter, catch those really easily. I think it's especially useful in those circumstances where you feel a little bit lost, or you're just kind of very early on in your process and still kind of learning, because it allows you to build your own chart eye. And, there's no replacement for actually trading and learning, live, making mistakes that way. But this is kind of the second best thing, where you can study, learn the characteristics that then you can recognize in real time when the market's developing, to look for and find those big winners just as they're getting started on their moves. So that's why to me model books are so important. It's the best way to practice. And Ross, I know you want to talk a little bit more about how helpful and impactful the 1998-2000 model book was for you, because you were kind of early on in your process at that point too. You were just a few years into working at William O'Neill and Company.
Absolutely, absolutely. And so, and I mean, you'll see here if you've read through. So a lot of, I would say this, so sitting in my office with Mike and Charles, I will say a lot of us, we had the same questions at the same time. Why aren't we buying here instead of here? And just stuff that was going to enter your head, and you make note of this along the way, and you go, well, you start asking those questions because it's different than the rules, let's say, that you learn from the book, right? And this is how you start thinking and tweaking and comparing. So that was actually kind of the beginning of my whole thought process to early entry, right? Was working on this model book, followed up by incorporating Stan Weinstein into my process, which gave me, and we'll get into this further. And then I basically, when I was running the hedge fund in New York, I'm a big believer of putting observations to work to see if they work. I don't care what kind of genius you have run a back test for you. There's nothing like buying 100 or 200 shares and testing an observation. And does it work? Yep, it worked that time. And you'll know if it works or if it doesn't work. Your P&L will tell you in a hurry. That I promise you. And to be quite honest, I have found that to be an extremely effective method for me. When I notice make an observation that seems to be very strong, I will just go test it. And that is how I slowly, and the reason I had to do that was moving into hedge fund land. I was, we started off with 120 million on day one. We grew it pretty quickly. And so, as you get up to over $500 million assets under management, and you're running that on margin, you're buying on
just buy the pivot
like we did in this market, and paying up for extended names in the wrong environment will destroy you. I mean, you can't. So what works in one environment doesn't work well in the next, and that's hard to get used to, especially when you've gotten. I can't to this day, almost 30 years later, I still have that. I still have to tell myself it's extended. Don't chase it. It became it's ingrained in me to, to still want to buy a stock that's up $6 above its 10-day moving average, and it's, less than $100 stock, because it came to a point, when I was learning that if you didn't do that, you missed. And that's certainly not the case now. Now it's a game of patience, right? It's a much choppier, less smooth environment. And if you try, I can almost guarantee you the optimal buy point here, if you were to go back and look at where I paid for stocks, if you were to apply it exactly to the market today, I'd be willing to bet that those would be some of your best short entries on the planet in the market environment currently. And I'll just go on to one more thing besides, entry and exit. It's these environmental things like I'm talking about. You will also learn that even if it's a smooth uptrend that you're back in, depending on the time, and I'll give you a perfect example, 2009, after that 2008 crash, all the garbage, all the stuff that got beaten down 70-80% rebounded. Nothing recovered, but it rebounded sharply. So if you were into buying the garbage off the bottom, that is what performed best in 2009. It was not a year for William O'Neill canned slim trading. It was very difficult, if that was your style, and yet very frustrating because the market went ripping straight up in 2009. And if you were trying to trade canned slim, you did not have an easy time. In fact, I did better in 2008 than I did in 2009, which you won't hear many people say. So, and all of that, I will tell you, came from being, and I will say forced in a way to do research projects like working on model books and, teaching the workshops with Bill, which, thank goodness and thank you, Bill, were some of the most valuable things to my entire process and learning. So we'll start here. What did I learn from Bill during this period? What I did learn from Bill is, if you focus strictly on the best of the best, right? You want, when I say story, what company is changing the way we work, live, communicate, what's making the most money, of the big funds who are buying these companies, are they continuing to accumulate shares, and what kind of long-term track records do they have, right? I mean, we're essentially riding their coattails, and top relative strength, right? We're looking for the strongest names. So that is, what I'm typically, that's the key focus of any model book I'm working on. And then, once I'm sure that I'm looking at the best of the best, the soundest companies that, the best mutual funds and hedge funds on earth would put their money into, that's where you're breaking down and developing your list to study. And you'll see as we move up, Bill tends to, and there's nothing wrong with it, he's going to go for the best of the best. Will have fewer choices, right? Because you are going to eliminate anything that has a flaw. Technically, you're going to eliminate, even things that have flaws fundamentally, where you might have like the triple digits and then an off quarter, right? You're going to get in the least trouble that way, right? You'll hear many people stay away from the biotechs. And this always made the most sense to me. When the biotechs are, when the group is really working, there's always going to be, now in that group, the reason I refer to it, and we'll get to that further, is just because in general, many of those stocks don't make money. However, they can be extremely powerful. And so that was just, anyway, we'll get to that. That was one of my key takeaways, that I pulled out, here's what Bill does. Bill, so let me get back to, and I'm all over the place, why I got there. There's, I think, close to 800 names in the biotech group. However, let's say a very small percentage make earnings. Bill will be the first one to tell you, stick with the two that make money, that have increasing sponsorship, that have, growing earnings, that have all of those things. And the other seven, let's say there's 760, I'm making it up, and there's 3 that meet that actually have a drug that they're selling that meet. All the rest is garbage. You don't need it, and he's right. However, if your style is to, take on a little bit more risk and, figure out a way around it, develop rules around, and so that is, I guess, why, what I learned from Bill versus what we'll get into, what I've taken away from model book building. So
yeah, just saying that to that, Ross, he would be extremely heavy on just one or two names. So like his requirements were just the strictest quality, and he had to know the intimate details of everything, versus
Correct.
your style. You're still very concentrated, but you might go into a handful of names,
The-
a little lesser size than he would go all of his
yes.
account into one or two names. So
That
yeah,
is the very important point you make, Richard, right? And he operated mostly on weekly charts, and yes, he put all of his money in one or two names. There was no
cowboy.
performance boosters. There was no, okay, I'll buy a few smaller, less liquid names. That was for the rest of us to do for him. He put all of his money in usually one, maybe two highly liquid names, and we'll get into what those look like, in terms of personality, which was, another one of those things that I learned over time. But here, let's back up to the actual process, right? So first, you want to define what is the objective of your model book. What are you trying to do, right? I'm looking for the best stocks in the best group with the best earnings, with the best performance. You might be looking for exactly the opposite. You may have made an observation that when I buy, an entry exit observation based on, I'm going to make up a simple one, a MACD cross off the bottom over, on daily charts over a particular time frame, or in a specifically two groups of a sector in a very strong bull, whatever it may be. You want to define that and then understand, what are the best situations for that particular study or whatever, right? So for me, I'm looking for the highest performing stocks, let's say with the fastest growing earnings. You might be looking for the stocks of a particular liquidity in a certain group during a particular period that, at whatever it is. And when the MACD crossed and you look at the ones, let's say the top 20 or 30 that were like, holy cow, these were the models for the year based on everything that I look at, and then study those in the same way. But you want to have a very relevant list of stocks. And again, we'll get into how I pare down my larger universe into a smaller list, right? So time period, that's part of your objectives, right? So you want to be clear on that, whether you're studying weeks, months, or years. Yeah, and I guess that
We covered that, yeah. Yeah,
we've gone through it here. So
and
anything?
just to give some more examples, you could be studying earnings gaps, you could be studying gap downs, you could be studying when we undercut the SMA, the 50-day moving average, and pop back up. You just want to be very specific in that criteria, because one, it's going to allow you to be a lot more selective, and the study is not going to blossom into 3,000 stocks that you have to go through, which is very valuable, but you want to do it in bite-sized pieces, especially if it's your first one. So keep that in mind. If it's a 3,000 stock project, it's never going to get finished. Like, you're going to keep on going through, and there's too many to go through. You got to wrap your head around, 20 stocks max. Probably your first one could be 5 stocks. Just go really in depth. That should be the way to go. But
Absolutely.
yeah, whatever special situation you want to study, go for it. You can tailor the process that Ross is going to speak to that. And for him, the criteria he's looking for is top performance of can slim quality stocks over typically a year or a cycle. So just want to clarify that. And then you can use screeners like Deep View to look for different situations that then you can, build kind of a master list that then will show you how to pare down. So yeah, Ross, I think we can keep going to the next slide.
Gotcha. And I was thinking, so yeah, I think maybe that we could have
Yeah,
put those in better order. But before we do that, then I
spoke to
kind of,
this a little bit. Yeah,
yeah, I did it's I jumped ahead. We talked about this in the slide or two before, right? So Bill, just Bill's original perspective when I was learning. If it wasn't for him, I would know none of this. I mean, I can't tell you what. I mean, so and let me make it clear, I built it with Mike, Charles, and Bill. So we would work on it, but everything had to be approved by Bill, the final list, the final everything. And so this is, also how I was lucky enough to be able to make these observations, what I was thinking, what they were thinking, what Bill told us to do, and then the actual observations we made along the way and, over the last 20 plus years, right? So, um, Yeah. So
Yep.
that, I started with some very basic can slim objectives, and the more model books I make, the more I come up with, the more observations I make, the more I refine my rules, right? So, yeah, starting from 98 to where I am now, I could probably count if I really tried, but I've built more model books than I could count right now off the top of my head. That's for sure. I can say it's an extremely valuable process. Start with 5 stocks, but figure out something, start with 5. So, it's like getting back to the gym. If you do try and do too much at first, it's never going to happen. Right.
You can't get
So,
hurt.
yeah, take it easy on yourself. Go make it fun. Make it so you want to do it again.
Right.
That's all yeah. So again, determining the scope is, like we just said, your objectives, your time period, exactly what you're looking for. And we're going to go through now, like what Richard said, and I'll start. You'll see on a following slide. I always start with just the Google search, top performing stocks during X, Y, Z, right? And then I'll take it from there, and then I use Deep View to break down the market. There's tons of software that you can do it, paid, free. But anyway, and then I will hone in on my list from there, right? And the bigger the period, right, from 98 through 2000, I mean, what a bull market. We had a ton of stocks to really narrow it down to. So I learned a lot from that process with Bill, whereas, there are much thinner bull markets than that, where, it's hard to come up with 20 or 30 stocks, whereas, it was hard to minimize it to 20 or 30 in that particular time period. Then, yeah, so once you've got your list decided on, then comes the nitty gritty, right? Opening up your charts, and what do you do with them? Where do you draw your lines? How do you start your study, right? And then, that is the process of building the model book. And and we can discuss some of this, studies that can even be performed after that we don't cover. I'll just mention. So again, like we were saying, I should have clicked ahead. Start with your basic Google search. For me, again, my routine is every day, all day, every day. So I have endless lists. So to be fair, and I keep it in my deep view. I have lists created. So if you're Ross, I need you to make a model book for, January 1st to July 23rd of 2024, I could put together a pretty good list before I went to sleep tonight, just because that's all I do all day, every day. But had I been starting from the very beginning, and I only look at the market once, every couple of weeks, because, that's what my life has time for, or less in many cases, right? Anyway, you get the idea there.
Yeah, and we also, like, in the chats that we're in, we also kind of contribute tickers too. That's another way that you can kind of source ideas. Just wanted to add that in. Rye, myself, we've all got, stocks we've been focused on, and when you kind of are starting the process, we kind of throw lists at you, and then you kind of use that and see what you want to include, what you want to throw out. So that's another way that you can kind of get ideas, is just have a group of friends and do it together. That's another way to make it more fun, right? Is do it as a group.
Yeah, I mean, finding the stocks really shouldn't be the problem. I mean, with a simple Google search, even guiding you to the software to help you hone in some more, that shouldn't really be an issue. But it is important to get the right list of stocks, especially when you're doing a larger study. When you're going to focus on just 5 stocks to get yourself started, pick the 5 that best match your objectives and go. Don't worry about what you're missing. Get the process underneath you and feel it. That's all I can tell you, is from the larger list all the way down to completing your book and everything that happens in between. That, I think the best 2 words for that is do it. Like, feel it, feel what that does to your brain after you go through it. I think it will propel you to want to do another one. So
Yep.
Anyway.
And then this is the hard part, getting that final list.
Whoops, and it looks like I left a little mistake on the slide there. Sorry, everyone. But so again, and I kind of covered it before, how big your list is going to depend on your study, how long the period of time is. And it's not always going to be minimized by your period of time. Again, if I'm a day trader, but let's say my time frame or time period, I'm now honing in on 1 month of the stock market, right? Let's say we look at it in months, this month versus this month versus this month, and I want to see how 3 entire sectors or 3 entire groups did that. Now I've got more stocks than I know what to do with. Now I've got to go, okay, which in those lists of those groups are the most important? How would I want to sort that? For me, if that was the case, I would want to sort by what are the highest relative strength with the best earnings, and liquidity is going to play a strong part, and that basically all ties into the sponsorship, right? Big funds can't buy thin stocks, right? So I'm just, on my mind, that is how I would, if I had, again, if I was a day trader and I was looking at several groups, but it wound up being hundreds of stocks, depending on my, if I was a short guy, I'd be looking for, possibly the low relative strength stocks that have all run up X%, have formed, X, depending on what your strategy is. And, yeah, it can't hurt to pick the 5 best ones that match and start there, but start somewhere, keep it small. You will feel the value of it when you're done. Yeah, so for me, very simply, I said it all, but if that didn't bring it down, for me, if it wasn't liquidity, price, relative strength, I have a list of stocks characteristics based on my objectives, based on my study, that will help me pare down a list of hundreds to 30 or 5, if that, to make it relevant. So once you've got your list, now you open up ABC stock, right? You got a blank chart in front of you. What are you looking for?
And just to jump in,
Yeah.
I know we're just kind of showing the theory here. We'll kind of give examples later on. So we're just kind of talking through the process, and then Ross is going to actually walk us through a few examples and point stuff out on charts. So yeah, stay tuned for that.
Yeah, thank you for that, Richard. That definitely clears it up. So yeah, don't get worried. Yeah, that we're not looking at pictures yet. We're just going to discuss quickly and then go through in detail, right? So when I'm looking at a blank chart, what are the things that I'm looking for that are relevant to my study, that are going to help me understand where optimal entry is, and where a stock is and its overall cycle, all of these sort of things. So starting with, a William O'Neill, Can Slim style trader, base stages are very important, right? So early or late stage, obviously, I know in my book, I'm picking stocks that have gone through an entire cycle from early to late stage. Right. But again, you want to be aware of what this, depending on your objective, what your book is. These are bigger picture things you want to be aware of, right? The larger cycle, bigger picture. And I move down to the smaller, right? So what is a launch pad? I'm looking for, so that is I don't want to call it a setup, but a specific thing that I look for that happens. It's one of my observations. I have it there, where all of the moving averages are converging in a tight bunch beneath a stock's price as a potential right side begins. This is something that happens around bottoms. As the indexes do it, stocks typically do it in groups, right? So for me, this is one of the key things that I'm looking for on charts. It's also it happens, it can happen at the bottom of any base, but in general, that is just about how the earliest entry points on any model book stock, since I have developed this way of entering stocks, they always start in this manner. So I now go look for launch pads to form. Okay. And that'll make more sense when we look at some stocks. So relevant trend lines and other logical areas of support. So relevant trend lines, meaning the top channel lines, they can be diagonal channel lines, declining tops lines. It can be channels, up the bottoms of a stock
Uptrend,
moving
yeah.
up the right side. Yeah, so all tops of bases, bottoms of bases, prior highs, prior lows, but yeah, trend, resistance, support, and most importantly, pivot points. And you're going to see again, we're going to go through and I'll explain how I go from blank chart to drawing those lines to the fine, the detailed labels, right? And then once I've got and so what I do is, and to be quite honest with you, I will start by drawing what I see as all of the relevant pivot points, trend lines, and then I said, right, so when I look for confluences, right, meaning those are where, let's say, a moving average, a trend line, the top of a base, and, 3 averages are all lining up, that is going to be a significantly more level than if it was just, let's say, whole number support, where we've gotten support a couple times, and that's really it, right? There's going to be a difference, and it doesn't mean one is absolutely going to work and one isn't, but the more things you have lining up at a particular area, in general, the more, right? And again, that's something that becomes part of the study. This is something that I guess we have learned over time, and I continue to watch for, and it's still the case, right? Where I have a big confluence of indicators, like, or significant, or not indicators, but indicators pointing to a significant level as significant. The more that are there, the better in general. And then from that point, as I go through, so for me, I have a very good idea now of what the fundamentals look like. Stock in an uptrend is pretty easy to focus in on, especially when you're looking at a year to 3, right? You can look at a weekly chart and know, right? That's not very difficult. But so once I have what I think are my relevant key pivot points and logical support and resistance areas, I then look and go, okay, where is the earliest point based on this chart that I could have entered this stock, and based again on my trading methodology, assuming that I employed my normal sell stop rules, assuming that where would my sell stop be, where would it, and I then, I'm playing Monday morning quarterback here, right? I want to see what would have been the optimal spot, had I could, had I known in advance where to buy and what would be the, the perfect sell stop. So that, and I will tell you this, that in and of itself, not only are you ultimately doing a study to figure out how that lines up across a group of stocks, it's also going to give you a great idea on how you, right? It's really for you. This is your model book, how you would have been, because you're looking at it going, wow, this was the perfect buy area. I know I bought it here, or I was supposed to buy it there, but this really is the perfect spot because look, it worked, right? It's working. Here would have been my logical, my tight logical sell stop. And I lost my train of thought, Richard. Can you?
All good. What I'll add is, when I'm going through this process and analyzing and labeling a chart, as Ross said, you look for the ideal buy point and where you'd want to enter, but I always kind of try to take it a step further than that and think about, all right, if I want to enter here, how would it have gone on my radar? What screen could I have run every single day to look for this type of stock? Was it, a big move up on volume? Was it a daily closing range when the market was weak? You can look at it that way. So you're not just kind of looking and saying this is the ideal trade, I'm going to magically get that every time. You're kind of taking it a step further. It's like, going forward, how would I get this type of setup on my radar? How do I find launch pads in the future? And then you can incorporate that going forward, build some rules around it. So that's all I kind of wanted to add, Ross, and I think that's pretty important. Yeah.
Yeah, and I think that's exactly where my brain was stuck. But yeah, because then you're showing yourself based on that, over and over again where those optimal spots are, and try that then you use to take forward into your trading, and you keep adjusting like that, cycle after cycle, book after book. The major rules are going to stay the same. They haven't changed yet in any way, shape, or form. However, this is what's going to allow you to really hone in on your detail your process, right? Know exactly based on your eye, what works for you, the observations you would make. Like Richard's saying, how will you, once you've got down what that optimal spot is, how are you going to find those setups again when you find a similar
In
stock
real
in the
time.
future? Yeah, and that's exactly correct because, again, for me, now after enough model books, I'm looking for, to be quite honest with you, I'm looking for leaders that not only match all of the criteria that we've discussed, but I specifically want ones that trade, that are liquid, that respect moving at like key moving averages time after time. They're the easier ones to trade. I've noticed, in a market where there's a plethora of stocks to trade, I'm always going to gravitate towards the one that trade in nice tight ranges, respect key moving averages and other logical areas of support, just because those are the stocks you can trade with the least aggravation and the least thinking. They follow your right. And so I'm developing rules around those. And I've realized that since the late 1880s until now, that same thing continues to happen. And yeah, it might switch a little bit. And, this is probably, no, definitely the way I continue to analyze what I'm doing versus what's working, what has worked in the past. And it really helps me tweak my process along with, doing post analysis. But doing the model book studies are key. Bill doesn't keep doing what doesn't work. I've never seen a guy cut faster what doesn't work. I don't care what it is, from losing stocks to layoffs in the firm. I mean, the guy is way ahead. He's super proactive. So anyway, again, I lost my train of thought there, Richard, and I'm really sorry.
Let's jump to the examples and just say
Yeah.
jumping to the examples,
Okay.
and we'll do it that way.
All right. So jumping to the examples, let's actually take a hard or a detailed look at what's going on here, with some pictures in front of us instead of
Just
imagining
text.
like we've been doing till now. So Nvidia, so the three stocks we're gonna look at, you are familiar with us and you're a growth stock trader, you're going to be quite familiar with. They were three of the best stocks in 2023. So Nvidia, Abercrombie and Fitch, and SMCI, right? So we've got two semiconductor stocks and one apparel stock, retail clothing and apparel stock. And I like to show the mixture there. You don't have to always be top technology stock to necessarily be a top performing growth stock. And so anyway, that's how we got our mix there, right? I think we all know that semiconductors have been the big leaders, but we thought Abercrombie was relevant to this presentation. So for starters, right, I want to understand sector and industry, right? So in 2023, semiconductor equipment were your top performing stocks. Nvidia happened to be one of the top semiconductor stocks, if not the top semiconductor stock. So we've got a little description about what they're doing. The Nvidia is one of these big winners that is clearly disrupting the industry, right? They, from what I understand, and I don't read it every day, they've basically got a monopoly on the chips that people need, although, that can change with time. And I know there are companies out there working on their own chips. This has been the monster in the group, and it continues to be for now. So just wanted to show you here, these are quarterly and annual earnings and sales, just an example of what I'm looking for there. So on the fundamental side, you'll see when we start moving on to the charts, this is some of the data we've got included with the price and volume. And so first, what I like to do is take a look at a weekly chart, okay, to get a look at the big picture over time, right? You can see here we've got just a little bit before 2021 to a little past the beginning of 2024. So you get the forest for the trees look that you're not going to get on the daily chart. And so there's nothing labeled here. This is just the big picture look and some important fundamentals. Now we go to the daily chart, and this is where we're going to start as if Nvidia were blank here. How did we arrive at these lines, these labels? Why is any of this important? So let's assume this stock was a blank chart. Like I originally said, the first thing I will do is, we've already looked at the bigger picture, right? So we know this is the bottom. We're moving up the right side. As I mentioned earlier on in the presentation, launch pads, and I don't have them circled here, but we've got a very loose launch pad situations going on here. We've got moving averages crossing, but it's not anywhere close to the launch pad, the nice tight launch pad setup we've got going on here. So I just want to point that out, right? So that's what's pointing me to this area near the bottom, not to mention, we already looked here and we know we're at the bottom. So we're starting there, well aware that Nvidia is, is the biggest winner in the strongest semiconductor group here. So I want to know, what are my important lines? To me, important lines are prior highs, declining tops trend lines, which are these diagonal lines, and pivot points. We've got base pivots, which those of us who trade the canceling methodology are all familiar with from Bill's book, right? If this were a proper cup and handle, which it's not, this is a consolidation pivot, but assuming this were, right, that would be a base pivot, the high of the handle. In this case, it's a consolidation pivot. Again, that is one of those things that was developed out of model book studies, right? And studying other model books and combining it with Bill's and Stan's methodology. But that is where we're starting, right? So starting at the left side, we can't see it here, but I know me, this is connecting to something relevant back here on the left. So my point is, and you'll see here, we've connected in at least 3 points, right? So the point is, this is a significant, relevant, long-term declining tops trend line, as you see there, right? So we're pushing through, but again, we're doing this. This is Monday morning quarterback. We see that didn't work, right? So maybe we want to say we can go back and try and figure out were there flaws there. But that's for another discussion. So here's my first big declining tops trend line. Then as we move up the right side, where are my relevant trend lines and pivot points? So as we move up, right, we get the pullback, we shake out under the moving averages. And now we've got a new or a much tighter launch pad setup in the works here, right? We're now making higher highs, higher lows. We're turning back up through the moving averages as they've tightened up and began to converge and then expand to the upside just underneath the stock's price. And like I was saying, 9 out of 10, if not all of my model book stocks start out like this, right? And that's nature of the beast. I'm looking for stocks that have gone at least, 2 to 3, if not 4 or more base stages, right? And for those of us who aren't familiar, and I'm going to keep it very quick, Bill O'Neill counts base stages, base 1 being that first, bottom base. Stage 2 would be your next base after the bottom. Stage 3, stage 4. Stage 3 and 4 are what we qualify as getting into late stage and much more failure prone. So that's, again, one of those things that we're aware of, pay attention to, and see how things may change or develop around that, right? Our stocks now doing 5 and 6 stages more, these are things that you may make an observation of, or is it just the same thing? Your best bet is, putting your big bets on those first stage 1, stage 2, and then you've got to still be much more careful stage 3, which is how I continue to play things. I'm a big, I do it like I'm playing blackjack. I need a hot deck. If I'm not sure the deck is hot, I back away. So starting at the very bottom here, right? The first thing that sticks out to me, and this is going to be easier to me because it's something that, I guess has popped up to my eye over time, these early up the right side entries or consolidation pivots, I like to say, right? So we know from looking at the weekly that we've already got an uptrend here. So
So you're looking
I
for
want
spots
to,
on the daily that you can enter and manage risk after you've
correct.
identified that longer term uptrend, the launch pad, that consolidation pivot right over the launch pad. That's probably
Hmm.
the ideal entry right there. You've also got maybe an outside day there. If you can point that out, Ross,
Hmm. Yeah.
right
Outside
there.
day.
That's probably the ideal entry through the consolidation pivot. And that's before the base pivot, which is probably 10% higher there.
Hmm.
But it's a spot where you can manage risk super easily. Setting your stops at just below the moving averages or below the consolidation. I know further on the additional buy points, you like to use the 10-day moving average a ton. So maybe you want to point that out as it keeps moving higher.
And that is a personality, right? So I'm going to choose stocks that respect those key moving averages. This is
Right.
there, it's not right. So not only are we respecting prior pivots, but it notice you got the confluence of a prior pivot roughly and that 10-day moving average. So, and it proves it to you. And when it doesn't hold the 10-day, it pulls into the 23-day and gets support. And look, you get that big reversal off the top, doesn't hold the 10-day, get supported. And it starts to show you its personality. Very often, this personality will be reflected on an uptrend on the left-hand side, and you will see it continue. So that's a big takeaway from these model books. Stocks have personalities. Those personalities can change, but I would never assume a personality change until the stock's personality actually changes. I've made that mistake one too many times, buying a whippy stock thinking it was going to break out and all of a sudden turn into a tight liquid trader. And that can happen and does happen, but you'd rather be late, a little bit late after it happens than early before it happens. That I've made that mistake. I like to, and I'm going to be honest with you, I like to anticipate trades like the anticipation trade. This is something I talk about in our um, anyway, a course that I'm working on. But I mean, those of us that are familiar with just whatever breakouts, Oliver's wedge pops, you got wedge pop after wedge. Am I right, Richard? Here
Yeah,
and
wedge
am I
pop off the bottom and then reconfirmations kind of the first pop through probably right before the launch pad pivot that we pointed out.
Mm-hmm.
That would be the wedge pop. So the range off the bottom there, that first consolidation pivot, the breakout through there would be Oliver's wedge pop, and that's something that I look for when I'm annotating. I look for the wedge pop, Oliver cycle, pullbacks to the key moving average, which this one has multiple ones to the 10
Right.
day, as well as the your purple line, which I think is either the 21 simple or 23 EMA. So you key in on these things that show up every time in these liquid leaders, and that's what you kind of want to train your eyes to
Yeah.
show. The tight ranges, the reconfirmations up from the ranges, the orderly pullbacks to the moving averages, the strength off the moving averages after the pullback. That's pretty much what you're looking for, Ross, and that's what you're trying to annotate here as you kind of go through here. And maybe we can move on to the next example after, unless there's
Absolutely.
anything
Absolutely.
else you wanted to cover here.
No, it's the same thing. And so you'll see that stock, right? We ended here, we'll
Yep.
pick up here. And this is its next run. And again, you can see those same personality traits hold. And what do you know? When we finally, for the first time closed, gap down close below that 23-day moving average, sold, right? And I mean, again, in general, I will wait a day, and that's why I say sell stops ultimately triggered because you didn't close above here, right? You were 2 days below, and that's just my rule, right? Like Ray says, there's a point where you make a point where you say your trade is wrong, your sell stop is your sell stop, you don't move it. There's no moving sell stops around that. So that being said, you've got to consistently follow the same rule or it doesn't work, right? So my rule is second day it closes below that average, you're out. And like clockwork, it breaks the 50, ultimately catches support at that 65-day exponential, works in a similar way to what we saw before. Stock would break the 10-day and stop at the 23 or the 21, right? The 21 is the cayenne line, the 23 exponential is the purple. But you get out of the way here and then you wait to enter again. And you see you're gonna wind up buying back just a little higher than you wind up getting out of the way. And you know, getting out of the way here and waiting for reconfirmation here. And ultimately, you see what happens. You're going to get stopped out. That's what your sell stops are for. But this keeps you, sure, you could have held and just ultimately had a sell stop at the 65. But based on the stock's personality, you know, when it breaks that 23-day, second day in a row, you're selling at least half, if not all of your position here. And then it does it again below the 50-day. At this point, second close below the 20, second close below the 50. I don't care what happens anymore at that point. I don't want typically, that black line isn't magic. And if I look back to the left and let's say I saw the 65-day to be just a key moving average for Nvidia in and of itself, right? There are some stocks that are going to respect that 65 exponential, which is this orange line, much better than they will the 50-day simple, this black or gray line. And in those cases where the stock tells you, I respect the orange line, not the black line, base your sell stops on that. It's that simple. The personality will remain the same until it doesn't. And that has worked really well for me following that, personality trait rule. And it's something that I've model book after model book seems to hold as a really solid rule to follow consistently.
Yeah, there's a point to add, there's a point where the trade is over for you, where it doesn't necessarily matter if it continues higher after that point. By your rules, you should be out, and then you could enter on the next setup if it resets up again. But for the purposes of model books, you want to try to follow your rules and say, where would I have exited in the moment? Did that make sense within my rules? Maybe you have to adjust your rule after studying a bunch of stocks and say, that rule doesn't really make sense anymore, but you have to kind of follow your rules so you have a place to start. And this one, you exited it base for another few months. It did go higher, but then it pulled back. And kind of there were multiple spots along the way where might have been a warning sign. You note that heavy volume negative reversal, and this is kind of a more of an example. We don't want to get into the weeds of Nvidia specifically, but heavy reversals on the upside, as well as big upside reversals at the bottom of bases. That's something you'll notice over and over again in the big names throughout their trends. The heavy reversals also often mean there's going to be a few weeks of basing, which ended up happening with Nvidia before it had that another leg up, which we know. And then big upside reversals at the bottom of bases. That's going to be a point where maybe it's the low for that cycle and it's ready to push up the right hand side. So those are some key things to key in on as you're annotating the charts. Anything else to add here, Ross, or do you want to move on to the next example here?
Yeah, no, that's absolutely perfect. And I guess the only thing I'm looking back at the only thing I wish I had done here is, as maybe pointed out the more relevant launch pads right down there in our stage one off the bottom. But here, as we get more extended, let's call it stage three, we got the big reversal. While we do have one here, right? We know we're now stage three breakout. Look,
It's
that
lower
breakout
quality.
just reversed and failed. That makes the, so if it doesn't hold this, that's telling you something. And it also tells you that even though that this is going to be less significant in the stage three base after a big run than it was back here, when it was 153, then up here when it's almost, $500, stage three base more or less. And so while you do have that, now again, I think we all know what happens because we know where Nvidia is from here. And again, we've got a
Launchpad,
launchpad set
and
up
that's
there.
after more basing. That's after almost 5 months
Correct.
of basing. So what you were pointing out is that it's a kind of a stub your base stage three, and then you just
Right.
kind of see those failures. It just needs more time at this point, and
Yeah.
obviously it does set up again.
This big undercut right here, that undercuts everything. This is something that I know when we used to look at all the charts with Bill and we were going back doing the Monday morning quarterback thing to apply to the future. I can't tell you how many times he would point to the shakeout undercut and just back to the left, everything that it undercut. That was kind of your in retrospect, that was your reset bar right there, buying in here. And you could even could have played this as a bit of a range undercut and rally trade like Ray does and bought it on the second day and look for that set, the buy, hold and hold that Ray uses. There's that would have worked perfectly here and you'd be in before the averages even crossed. So anyway, let's not get into the weeds and the details here. We're talking about how to
process.
actually, yeah. So Abercrombie and Fitch, we'll do next, we all know what Abercrombie is, one of the more popular stores at the mall, which I don't think I've been to in over 20 years. But anyway, they seem to have a very well-liked, popular clothing, I guess, right? And how do we know that? Just take a look at their quarterly earnings and sales, their annual earnings and sales, along with their estimates. And, you know, there's really no better indication of a stock than the stock itself. And here you go. You can take a look at that, weekly chart over the longer time period. So we get a feel for the forest for the trees, right? We had a prior uptrend here coming into 21. So we've got a big, long base forming here on the weekly. And it's a very similar thing to the last time. We have that loose launch pad, things try to get going. And no doubt all of this volume's below average. So we come back into support. And now we've got that big volume, right? That giant push. And I don't know what the news was here, but it's clearly after earnings, unless I have a screwed up chart here and earnings. But regardless, we've got a news catalyst here, whether it be earnings or something else, and that big outside bar to go along with it. So this is where we're going to be starting on that daily chart, right? As the stock begins to form the right side of its base before it actually breaks out and goes on this super tight organized run on its weekly chart. So that's what we're looking at there, right? With some fundamentals highlighted that are important to the methodology. And then we'll go through on those daily charts. And again, assuming this was a blank canvas, like I had just discussed, here's the launch pad that kind of fails. Like on our prior example, it's kind of loose, doesn't really work. So we come in, we undercut, form a new bottom, right? Start building the right side. And again, you can see where the potential pivots are along the way, where your potential declining tops trend lines are. So that's the first thing I start doing. I would say I probably start with pivot points starting right at the very bottom. And I will tell you this, I might even start drawing one here. In some cases, I will start with too many and have to remove some. In some cases, I will start with not enough, or I will not realize that something was relevant when I was first drawing them. And as I'm labeling stocks, looking for, the most relevant tight logical sell stops for a potential entry, I'll realize that I missed an important gap or high of an important candle, low of an important candle, or whatever it is. So remember, you're not going to get it all perfect the first time. You're just trying to mark those most important spots, right? Long-term declining top trend lines as they're broken on the upside on big volume. You want to watch for that, right? Launchpad setups, you want to watch for that. Potential consolidation pivots. This one was irrelevant to this trade, so it's not drawn. And to be quite honest with you, I probably, going back, if I wanted to make it super clean, I could probably remove this line and another. But you get the idea. You want to lay down the basic lines, your basic circles, mark the important price and volume, highs and lows, and then start playing Monday morning quarterback, based on your methodology. What was the earliest spot that I could have, entered the position based on where earnings were, all of my rules. And if I entered there, where was my tight logical sell stop? How tight was that? What are my rules, right? So for me, my max sell stop, which I try to almost never get to, is that 7 to 8%. For me, I try to keep it 3 to 5, 2 to 3 ideally. So for me, once I'm getting near, I don't, when I'm making the model books, I try to keep it 5% or less on the sell stops, knowing that my max is 7 to 8%. I like to be inside of that. I'm always looking through the lens of risk management. That's the way I do things. So that's what I'm doing. So once I drop my lines and figure out where I think my ideal buy points are going to be, I then have to be able to find legitimate ideal sell stops based on my methodology. Otherwise, you don't have a trade, right? And that's a big deal and not what we're discussing now. But if you've got an entry point and no tight logical sell stop, your setup is no good, right? If you don't have a tight logical sell stop for that entry, it's not a good entry, especially if you're playing in hindsight, right?
Yeah, and just to kind of share kind of what I'm seeing with this chart is before the launch pad, a little bit to the left, when it kind of tightened up at the bottom of the chart there, Ross, if you could point that out, there's a lot of upside reversal bars off the bottom, even
Yep.
before that. So that's something that I would note. You know, it looks like accumulation is coming into it. You know, it did have a severe drop after earnings. That's a lot of red volume there,
Mhm.
but it couldn't push lower than that. And then you've got those upside reversals coming in. Then, you know, looking at this chart, how I would look at it, I would think about, again, when would it come on my radar? You know, the launch pad, it would show up on that screen for me, but then also on that earnings gap, a big, you know, I run a screen pretty much every day looking for a big gap up on volume. It would definitely show up on that earnings gap, and then I'd be waiting for a tight area to enter there. It kind of undercuts where I usually like to operate around the HVC. You know, it pulls back a little bit further, Ross, if you could go up and to the right. It pushes up on earnings, goes sideways, and then kind of retests that HVC, but undercuts that and actually kind of retests almost the low of that gap. So that's something that I would note and say, hey, maybe that's a template that I should look for. And then it tightens up again. And that's probably where my ideal entry would be for me personally, is it compresses against that 21 EMA, tightens up for a few days. There's not much volume there. And I look for the expansion up, and that lines up. We were talking about confluence. It lines up. Where does it line up? With that base pivot all the way on the right hand side or left hand side. Sorry.
Yep.
And then, you know, that's kind of how I would label this chart and what I would be kind of looking at to give my perspective versus Ross more of a position trade type interpretation. Ross, I know there's more examples to cover here. Was there anything else on this chart that you really wanted to highlight for everybody?
No, that's really it. I think the most important part is for me trying to express why I'm putting lines where I'm putting them, because after that, doing the analysis is like the fun, easy part. I'll call myself out on them, you know, as I look at this in if I was just trading this in my personal account, I think, or my, you know, one of the accounts I trade, I want to say I'd start it right here versus that 23-day exponential on a
Right.
closing basis. And that's, you know, or I'd start buying in here. But
Right.
anyway, that's and that's my relook at this. So if I were to go back and, you know, edit this, I would note that in here. I actually like this for, you know, on that big spike after. But anyway,
Yeah,
that's relevant to what
and
we're
if you
doing here. But
if you're doing this personally, don't feel like you have to put all the lines Ross does. Ross also puts a million alert lines every single day. Find what works for you, what works for your process. Maybe you only want to put base pivot lines. Maybe you're not putting any diagonal lines. You're only putting horizontal lines. Do how you trade and how you would analyze the chart. Um, this is just an example showing how Ross applies that. You can tweak this process to however you want to do it. So, Ross, maybe we can move on to the
yeah, and
next.
I think if we're not, yeah, see, so there's 3 charts here and we got another stock, so I don't want to go on and on. So again, so Richard, you want to go through here? Is there any, you know, going through here, you can see
Yeah.
you know, just addressing lines. These were dragged across from the left side, from the left side of the base that came across here. Another major declining tops trend line. And you can see I'm just marking the ones that didn't come across. I'm basically marking any potential
Right.
pivot point, whether it be a base pivot, consolidation pivot, anything where it you know, a major support or resistance point I want labeled. And then, you know, I may need to subtract and add as I go along and actually fill in the details, right?
Yeah, and you can learn a lot by going through Ross's annotations in terms of how he views the market and his view. And we actually have that as a free resource. If you guys have registered, you can kind of go to courses and look at our previous model books. So all these details are great to study. Don't feel the need like you have to screenshot these. They're all there for you to analyze however much you want. So Ross, I think let's move on to the next
Yep.
example.
And
Yeah.
so, you know, I think I just realized these are the same chart with different shots. I'm not, so anyway, you've got 2 screenshots of the same chart here, right?
Yep.
Right.
Yep.
But anyway, so anyway, moving on to super micro. This is stock number 3 again. A little description of what the stock does, right? So you have an idea what industry group, what it does relative to Nvidia. Let's say it was a larger, this is from a larger model book relative to the other stocks in its group, right? You want to know its story. Again, quarterly and annual earnings, as well as earnings and
And
sales, as well as
and in here,
estimates.
Ross, are you always kind of noting down what the end factor is for that company? You're trying to identify that here, right? The fundamental story.
Yes. Thank you. So yeah, that's the whole point of me. So at least I have an idea of, yes, why SMCI is being chosen. What is the story? How is it? So it's another one of those big. So AI is a big theme in the market over 2023 and a lot of this year. Nvidia is your leading semiconductor company as far as AI technology goes, right? In terms of processing power and speed, from what I understand. SMCI is another semiconductor company, different than Nvidia, but a big leader in what they do. So in the same sector and industry group, but a little bit different business. And you'll
Right.
see as we look at the chart, it's going to also, it trades a lot more differently than Nvidia. And I wanted to put this in here as well, because SMCI may be, it's one of
It's more
those
small
stocks
cap.
where,
It's more whippy.
yes, it's much more whippy. And I would the way I would enter this one changes relative to an Nvidia. So,
Hmm.
and how do I realize these things? Experience, and then the model book, and then a lot of post analysis as well. The model books go and post analysis go hand in hand. Or almost you're cheating yourself to do post analysis without at least a small model book. So SMCI, again, weekly chart, forest for the trees look, and you can see here, there is no prior uptrend, new base, right? We've got this stock's been in a pretty solid uptrend, again, more whippy than an Nvidia, but since before 2021 and up until this point, you can see it's held that trend of higher highs, higher lows. Taking a quick look at earnings, sales, and all, we saw on the other page, the big triple digits across the board, and historical reported earnings and sales, as well as estimates. And so again, now we jump straight to those daily charts, right? So we're starting just before 2023. So right here is the beginning of our daily chart for reference. And again, so this is great because now we can see all the way to the left side where I started a lot of these lines and have dragged them across. And the funny thing is, when I get started, I'll be a little bit slow, but by my third stock, after I've done one or two, it becomes really fast how quickly you'll start drawing the lines. And again, here, I don't know why I didn't mark them. I only marked it on one, but we should have a circle right here at that launch pad setup that happens after, again, that big volume push outside day above all of those moving averages, the
Look at
cross.
the volume. Look at that volume on that tight area too.
Yeah.
Nothing. So
Yeah, and you
that's a
can see,
characteristic to look for. Yeah, big up
right, look
volume
how
and then
tight that is. Volume disappears to nothing, right? Big blue, small red. This is exactly what you want to
keep it
see,
simple.
right? Big on the way up, small red on the way down. But and unlike Nvidia, this one doesn't hold its 10-day moving average. It can hold its 10-day moving average, but it doesn't hold it as well, right? It shakes below. And when it does, you can see this one runs into trouble and it gets uglier much more quickly. So you want to treat this one differently than you would the Nvidia, right? The way, again, we're not getting into that, but that's what will help you with position, risk reward, entry exit, and that goes all the way down to position sizing. And this is one of those things that would help, right? So when you have a stock like an SMCI, let's say it's just irresistible in every respect other than it's a little more volatile or choppy than I would otherwise like, then I will change my entry tactic so I can get a position on. And then Richard, anything you want to add or along the way, because we're coming. Okay, so
Yeah, nothing too much. Just for me, SMCI, it's a whippy stock, and even the next base, if you go to the next slide, um, yeah, it had an amazing breakout there, but for a lot of that base, it looked like a stage 3 top almost. It was gapping down, downside reversals. Um, so that's the type of stuff that you can think about and remember going forward. A stock like SMCI that had come so far, it's looks like it's forming a stage three, but maybe the next stock that kind of fits that profile, you stick with it, you keep watching it because SMCI had that amazing run out of this base, and there's still that potential there. So those are just kind of little things that you can learn to stay in tune with the stock, even if the base doesn't look the best, because it has that strong initial uptrend. But yeah, nothing too much more to add on this one, Ross.
Yeah, so, and you can see I'm not really doing anything too different. It's just a matter of getting, starting with a blank chart and marking those where you think are the most important lines, starting with pivot points and trend lines. And then from there, playing Monday morning quarterback, right? Where would you have entered? Where have you entered in the past if you've traded the stock? And, and you start from there. And then as you detail your potential, as you're looking for your entries, your potential ideal sell stops, that's going to help you. That's going to further drive you to add and remove relevant levels of support and resistance based on the detail as you go. So again, it's not going to be perfect the first time. Expect to be adding and removing lines along the way as you go through and actually analyze the entry and exit areas if that's what you're doing, or the areas where your indicator is significant or whatever it is that you're studying, right?
Right.
So again, this was my takeaway from the model book studies that I did related to my methodology, right? So it's not gonna, again, the most common traits of the model book stock for me are going to be different for you if you're doing a different study, right? So just to be clear. So for me, again, and this is what I want to make sure this always exists, right? And this is, like I've mentioned a few times now, has existed since the late 1880s, right? Anytime I build the model book, these are the things that never change, that top-notch story, right? And that's why it's like one of the first things I put in the model book. I want to know, I mean, that it should be clear what the company's doing, why are they there, how are they changing the way we work, live, or communicate. For me, that is a big deal. And then from there, the canceling fundamentals are what ultimately supports that. The better the fundamentals, or I should say, the better the story, typically the better the fundamentals are, right? When you disrupt like Apple does, then you have more money than many nations on the planet, I guess is how that works. So, and then the other thing I noticed, and so tight, liquid, organized technical patterns, like I said, respects key areas of logical support, moving averages, highs and lows of gaps, important price and volume bars. So we saw I wanted to show, so you've got the Nvidias and ANFs of the world that trade liquid and a little bit tight, but you still can have an SMCI that is a powerful big leader that has a different personality. So for me, like my takeaway is, I guess, from the model books, there are enough high quality, big performing model book stocks that trade in this way, that have the tight, liquid, organized technical pattern, that what I call that have the aggravation free patterns, the Nvidia pattern relative to an SMCI pattern. And SMCI can get more volatile than that. That was just my example for here. But so for me, unless it's an outstanding stock that I can't resist with a personality that doesn't really fit my definition of a model book stock, I'll tend to stay away. However, as you see, I will still include the whippier stocks if all else is perfect, because I want to understand how many of those stocks show up, right? I always want to know, as long as, can I stick to the tight, liquid, organized, aggravation-free patterns and not worry about missing an SMCI if I don't want to touch it? And the answer is yes, right? So for me, those are my ideal key model book stocks. I want to include reality. But for me, that was my takeaway as far as what I now focus on based on my model book studies. It's not going to be not only the highest performing most fundamentally sound group stock in its group, it's going to be one that has a personality that, let's say there's two personalities of model book stocks. I prefer that one. That's the one that makes sense for me to trade. And I continue to prove to myself that there are more than enough of the, like Bill O'Neill will never trade, if at all, a biotech stock. If he's going to trade it, you bet your ass it's going to be, excuse my French, a Biogen, a company that you stick a shot in someone who, in someone's eye, who can't see, who's blind because of macular degeneration, and now they can see again. They made a lot of money selling that drug. It was extremely successful. If Bill O'Neill is going to be in a biotech stock, it's going to be one like that or not at all. So by the same token, I'm going to typically be in a super liquid, organized, aggravation-free model book stock, or I'm going to probably stay away, because the SMCIs of the world, no matter how good they are based on the way I trade, the way I see things, just a little more work for me. It's harder for me to perform trading those stocks. It's more work, right? So, and that's, you want to do the studies to see what's actually going on, but more importantly, to help improve your performance and improve your life, right? I'm looking for the easiest stocks where I can enter my rules, take care of everything. I have to do very little thinking, and I can, enjoy the rest of my life without too much stress and aggravation. So
there you go. Perfect. Was that? Yeah. So here's some.
Yeah. So again,
more takeaways.
I could have changed slides here. We'll leave it. So again, my apologies. I forgot to click the slides. I went ahead in my thoughts, but again, this is and again, some of the individual key takeaways, right? So one of the original ones, right? One of the original ones that I relate back to Mike and Charles is all of us sitting there asking the same thing on the same, going, why aren't we buying these stocks here and here and here? And, it was because it's too early. There's too much resistance from back on the left. But then I started then I incorporated Stan Weinstein, a lot of what his stage one top idea in many cases is what Bill O'Neill would consider junk off the bottom, right? So I'm not going to get into that, but that was a big aha moment for me and helped me develop early entry, right? Understanding that, you can get a stock with all of that resistance on the left side, and it does still work, right? So I'm very sure of that now. So again, like I said, especially now that I'm 52 and not 22, aggravation free trading is a big plus for me. If you told me about, hey, it's aggravation free when I was 24, I'd be like, I don't care. I want to trade MSTR and SMCI on margin anyway. I was there at one point. I'm far from that now. It's the last thing I want to be doing. Too old for that, as they say. And then again, in the beginning, when I was talking about how Bill will stick to the one biotech stock, the one that goes to the moon, that makes money, and who cares about the rest? Can't argue with that. But I made a lot of money in 99 trading biotech stocks with big stories and no earnings. However, I also learned if you walk away from your screen for an hour without sell stops, you can lose almost all your money in an hour. So again, just I wanted to be clear. You don't have to just be testing for entry and exits. You can be looking for a specific indicator, a new entry tactic, and then honestly, you don't have to do a big back testing study after that. You can test it with 10 shares, 100 shares. I like to test my observations in real time with real money in the market. That works really well for me. And again, the stocks having a personality, trying to stick with those stocks that have the particular personality is another thing that I took away from the model books, right? Just how to make my life easier. I don't need MSTR and SMCI to have a huge year. And this, I think I started with, from the very beginning. I can't, and I'm not going to go on and on, but I can't say enough how important it is, how helpful it is to build the model book. So do yourself a favor, when you're doing your post analysis, figure out, what are the 5 stocks you wish you traded? or the setups that you wish you had that you missed it. So yeah, just that process has done so much for my thought process, my entries and exits, developing my rules. It aids the post analysis incredibly. They go hand in hand. So, not only does it, the more you make, the better of a historical reference you have to go back, when you need it to use in the future. The process itself is more valuable than you can imagine, starting with those blank charts and ending up with a book that you can reference, going forward.
And Ross, do you print them out usually, or do you can't kind of keep them in PDF form, the ones you make?
So I will mark them up originally, but I have a whole model
Stack of
book
them? Yeah,
layout saved, and then ultimately, yes, I will print them out. I like to see them in black and white and pretty, and it also forces me to look through it in hard copy, because I will look through it if it's sitting on my desk or near my couch, whereas I'm not going to open that PDF on my computer. I
right.
know I won't. And then what happens is, as I start going through, it's amazing how many things I want to change. And then I go back and I will update that chart in my model book layout, and I'll print it again, right? And once I feel like I have my final there, and I will look at that, and those get changed. And then as time goes on, I start figuring out I've already begun to make my list for this year's TraderLion model book. It'll be coming up in a hurry, right? So
Yeah, going to the next slide. Key advice, like Ross said, just start with a basic Google search for top performing stocks. You can run a scan for stocks that were up the most that year. That's a way to find them. Especially if this is your first one, just kind of start small. Do 5, do one first,
yeah,
and
do
if
one
you,
or three. Yeah.
yeah, there you go. And like Ross said as well, and I said, it doesn't just have to be how Ross does it, which is mostly looking at the top performers. It can be going back and study a come and handle. It can be studying a MACD cross, a moving average reclaim, undercut and rally, whatever setup or thing you want to study. Just find good, solid examples of those over a period, and that can be the way to go. Some people might be curious about kind of what software that we use. For the charts, DeepView is kind of what we use, and then you can go back and Google to find news. You can we use Canva to kind of put everything together. That makes it really easy. You can even add annotations in Canva, and that way it's kind of saved on a different layer than your charts. And you can kind of change them really easily, copy the same one over and over again. So that's kind of the stack that we use, and then from there you can make that into a PDF. So Ross, anything to add there about specifically making the model book, the logistics behind it, or is that kind of it?
That's really it. It's not hard. It just takes some time, and it's a little bit tedious, adding in the detail, but worth every second you spend.
Yeah, perfect. And I think we just got one last slide, some key takeaways. Again, they can serve as a reference for historical precedent, and then going through the actual process kind of helps you find those edges. Notice the launch pad, notice the consolidation pivots, and the more you do, the better you get. I like how you end with that, Ross. Anything to add here on
Yeah.
the key
And just one more
takeaways?
thing, as you're making them, you can notice your rules changing. What used
Right.
to work, right? You can go, holy cow, that clearly something changed there. But I need to change a rule, a sell stop rule based on XYZ. That's another huge, that happened for me recently. So that's why I mentioned that. But the
Yeah.
value is unbelievable. And if you talk to 10 different people, they'll tell you another 10 things that I didn't even think to cover, that it was because it helped them in a different way. So
I know another observation that you pointed out going through the recent ones is in recent years, there's so many breakouts, failures, resets, and then re-breakout. I know you've noticed that observation specifically from building these. So you can kind of notice stuff like that as you're building them. And like I said, you can go ahead and check out the model books that Ross has done over the previous, I think back to 2019. Definitely very useful to read through those. It's available on Amazon as well as a free resource if you've got a free account over on TraderLion.com. And I think we'll be putting the links to them right now in the chat. So Ross, I think that's pretty much it from my side. Any last, words of wisdom that you want to share with everybody, encouragement, anything at all?
no, not really that, again, pick your top stock, your top 3 stocks that you would think would be the beginning of a model book for you, and pick a weekend, sit down and do your first one. Other
There
than
you go.
that, that's really all I've got for you. Make a model book, even if it's just 1 or 2 stocks. Get something under your belt. It'll. I'm gonna bet it's gonna make you want to do more.
Yep. There you go. There's your homework assignment for next weekend. We'll expect to see them posted on Twitter. Tag us if you do them. We'll retweet them. Give them a look.
Ooh, that would
Yeah,
be nice.
that'd be cool.
All right, yeah.
Maybe
Some marked up model book stocks would be great. So yeah, great
yeah.
idea.
Maybe we'll give some giveaways to people who do them. So hint, hint, go ahead and do that. So thanks so much, Ross, again for your time. To everybody watching, hope you enjoyed, and we'll be right back. Stay tuned. Bye.
Thanks, Richard.